Business documents serve a function analogous to memory in the human body. They preserve an accurate record of every transaction. Without documents, business relationships depend entirely on the honesty and memory of the parties involved, both of which are fallible. The business document system creates mutual accountability. The buyer's purchase order commits them to their order, the seller's invoice specifies what must be paid, the receipt proves payment was made. These written records protect both parties. The seller who issues an invoice has documented evidence of the debt owed, the buyer who holds a receipt has documented proof that payment was made. In any commercial dispute, and business disputes are a regular occurrence, the party with proper documentation has an enormous advantage. The invoice is the cornerstone business document in any credit transaction, a sale where goods are delivered now but payment comes later. Let us examine each section of a properly prepared invoice. The seller's details at the top: company name, address, telephone, email, and registration numbers, establish the legal identity of who is requesting payment. The unique invoice number enables both parties to file and reference the document precisely. I'm calling about invoice JK 2024-0847 immediately identifies the specific transaction without ambiguity. The itemized goods table is the core of the invoice. Every item sold must be listed separately with its quantity and unit price, allowing the buyer to verify each item against what was actually delivered. VAT at 7.5% is compulsory for Nigerian businesses with annual turnover above 25 million Nigerian nairas registered with FIRS. The invoice must show the VAT component separately. Payment terms specify the deadline. 30 days net means payment is due 30 days from the invoice date, after which interest or late payment penalties may apply. The pro forma invoice is particularly important in international trade, where it serves as a preliminary statement of cost used in the customs and foreign exchange approval processes before goods are actually shipped. A Nigerian company importing industrial machinery from Germany cannot access foreign exchange from its bank without first showing documentation of what the goods cost and who the seller is. The pro forma invoice provides this. The credit note is an important corrective document that every buyer should know about. If you receive goods worth 200,000 Nigerian nairas but the invoice shows 220,000 Nigerian nairas, you have the right to request a credit note for 20,000 Nigerian nairas that reduces your balance to the correct amount. Understanding credit and debit notes is important for both buyers, who should check invoices carefully and request corrections when needed, and bookkeepers, who must record both the original invoice and any adjusting notes accurately. The receipt is proof that payment has been made, the buyer's primary protection against any future claim that they owe money they have already paid. Every receipt must contain several critical elements. The amount must be written in both figures: 1,295,375 Nigerian nairas, and words, 1,295,000. This prevents fraudulent alteration of the amount. What the payment is for must be specified. A receipt showing only an amount and a date is far less useful than one that references the specific invoice being paid. The payment method should be recorded: bank transfer, reference ZEN 202406222-089765, creates an independently verifiable record. The signature and official stamp of the recipient authenticates the receipt. A receipt without a signature or stamp can be questioned. Nigerian consumers should always request a receipt for any significant payment, in markets, from service providers, from landlords, because a receipt is the only documented evidence of payment. Understanding the full cycle of business documents allows you to see how a single commercial transaction is supported by multiple written records, each capturing a specific moment in the transaction's progress. The purchase order captures the buyer's commitment at the moment of ordering. The delivery note captures the moment goods change hands. The buyer's signature here is critical proof that goods were actually received. Without a signed delivery note, a seller who claims to have delivered goods has no physical evidence that the buyer accepted them. The invoice captures the moment of requesting payment. The receipt captures the moment of payment. The statement of account summarizes the entire ongoing relationship between two businesses. It is particularly valuable in trade credit relationships where a buyer regularly orders from the same supplier and makes periodic payments against accumulated invoices. Walking through a practical invoice exercise consolidates your understanding of each document element. Notice how each question tests a different aspect of the invoice: who the parties are, what the total is, including VAT calculation, when payment falls due based on payment terms, how a receipt relates to the invoice it pays, and how partial payment creates a balance outstanding. In real business practice, a bookkeeper at Joseph Provisions Ltd would record: debit, Clara's canteen account, 849,250 Nigerian nairas when the invoice is issued; credit, Clara's canteen account, 400,000 Nigerian nairas when the receipt is issued, leaving a debit balance of 449,250 Nigerian nairas representing the amount Clara still owes. This double-entry bookkeeping principle, which we will study in detail in the next lesson, is the system that makes all these document records meaningful. For your exam, an invoice is a document issued by a seller to a buyer requesting payment for goods or services. 6 items on an invoice: seller's name and address, buyer's name and address, invoice number and date, description and quantity of goods, unit price and total, payment terms, VAT amount, if applicable. A receipt is a document acknowledging payment has been received. 6 items on a receipt: receipt number, date, payer's name, amount, in words and figures, what payment is for, signature and stamp of recipient. For other key business documents: purchase order, buyer to seller, delivery note, accompanies goods, statement of account, monthly summary, check, payment instruction to bank. Exam tip: know the difference between an invoice, before payment, request money, and a receipt, after payment, acknowledges money received. Examiners specifically test this distinction. Excellent. You now understand the key business documents that create a transaction paper trail: the invoice requesting payment, the receipt confirming it, and the supporting documents that record each stage of the commercial process. In our next lesson, we introduce bookkeeping, the systematic recording of all these financial transactions that forms the foundation of every successful business's financial management. See you in class.